Welcome back to the Financial Services What's Up, the podcast where we unravel the complexities of the financial service sector in Luxembourg and beyond. And I would like also to say hi to my financial services expert, Björn.
Hi Sandra, it's great to be back and I'm looking forward to the second episode. And by the way, hello to all the listeners out there.
So today we are thrilled to have Samir with us. Samir, he is our valuation expert here at PwC in Luxembourg, and he brings us the expertise that we need in terms of private asset valuation.
Thanks for the warm welcome, Björn and Sandra. It's a pleasure to be here to discuss private asset valuations. We have witnessed some interesting developments, and I'm excited to explore these trends and what they mean for investors and the market as a whole.
Yeah, welcome, Samir. So last year indeed was a year where the markets had some key developments, if we take it from an economic point of view, from a market point of view, but also from a regulatory perspective. So in today's episode, we'll explore those trends and dive into challenges impacting how assets are valued today.
And just before we start, a small reminder. This podcast is meant to be for seasoned professionals or just people who are really curious about the financial service world. And we try to provide the latest insights and trends. So let's get started and dive in.
So in the last one, we actually looked at the macroeconomic environment. We spoke about the high inflation rates, but also the resilience that is needed in our industry. Samir, the first question is for you. So given the indicators that were actually suggesting a soft landing with the inflation rates adjusting downwards in response to shifts in monetary policy, what's your view with regards to the valuation for private assets?
It seems indeed that we are headed into a so-called soft landing, except if an unforeseen black swan event that would basically come in and contradict that scenario. Some even talk about a no landing scenario at this stage. From the valuation standpoint, most recent data from Preqin shows that valuation have adjusted downward. We talk about between 15% and 20% downward adjustment from highs we experienced in 21-22, which reflects the current impact of interest rates.
That's quite a lot, huh?
Yeah, indeed.
Let's jump in here, Samir and Sandra, because I have been to the MIPIM lately, the largest real estate conference here in the south of Europe. And I have to say, what's the sentiment about among the investors? So I felt there is really a cautious optimism, tempered by the acknowledgement of the challenging environment. And given the weak economic growth, I guess it will be a challenging year for the real estate market. But on the other hand, the decrease of the interest rates will also help to boost the growth and also contribute that capital markets will see a revival. And also I have to say the MIPIM, I think there was the consensus that we are close to or even we are now at the market bottom of the real estate valuations. And there also I felt there have been some signals that there are now potential opportunities for investments. And I personally believe that in the second half of 2024, I think there we will see really again transaction and growth. So all in all, and Samir, I share also your view, the macroeconomic environment is challenging, giving also geopolitical risk. That really pose a challenge on valuations as uncertainties remain high. And that also means we will have higher valuation risks.
Maybe building on that point of the valuation risk, and thank you for the two of you to share your view on that. I hear actually in that context that the regulators have been quite active over the last years to actually tackle some of the impacts of this increased valuation risk, especially for illiquid assets, which include the private assets. Samir, then turning towards to you, what are you seeing then on the regulatory front?
So you're absolutely right, Sandra. 2023 was a year of focus for regulators on valuation of assets. ESMA has conducted its common supervisory action with regulators, then released an extensive report depicting findings on various areas of valuation frameworks for IFMs and AIFMs. The CSSF released quite rapidly a feedback on ESMA's report, basically setting expectations to broader market participants.
And Samir, it's not only the CSF in Luxembourg. It's really that all regulators across Europe now provided guidance to the entities which they are supervising. So, for example, the AMF in France or the Bank of Ireland and even the regulator in the UK.
That's right. So the FCA has publicly expressed its interest to conduct a full-blown assessment among AFMs that fall under its supervision in the UK. It recently published a Dear CEO letter where it discusses their future plans on that topic. IOSCO, which is the international body that brings together the world's securities regulators, also published a report named Emerging Risk in Private Finance, where it shared a number of concerns around valuation of assets.
Wow, that's actually a lot of development. I wasn't expecting so many.
Yeah, so this is the first time that we have this much guidance for asset managers, with all asset classes being covered, from public assets with, let's say, that would bear less liquidity, to private assets. The interest is clearly to strengthen the valuation frameworks for more complex products, investing those assets, such as open-ended funds, with underlying trends on retailization, basically, that we have seen a lot recently, secondary opportunities funds, and continuation funds. The ultimate goal remains the same. It's to ensure investors' best interest.
That's right, Samir. We have seen also in our financial service practice here at PwC Luxembourg that many market participants really try to ensure and are very active to meet the requirements the regulators give them. And also they try to bridge the gap between what they do and what they should be doing. And I personally expect that this will continue.
So in light of that information, I would like us to put the PE lens on. So when I'm reading actually through the business press, the private equity industry is grappling with a slowdown in deal making. This, of course, leads to a surplus of unsold assets and the liquidity challenges. So a reaction is the continuation funds as a potential exit strategy for private asset managers, and of course the IPOs, they remain. Samir, can you share a little bit more in relation to the recent developments in that respect?
Sure, Sandra. Thank you for raising that topic. Timing to exit in the current economic environment has been a big debate for asset managers. Most recent market observations from Lazard showed that exits to other sponsors, as well as exit to strategic buyers, have decreased substantially in 2023, almost 50% down from the most recent highs in 2021. The volume of exits through to an IPO have decreased even further by a whopping 83% over the same period of time.
That's massive. Massive change in terms of macroeconomic environment.
That's definitely right. So now may not be the best time to exit or IPO. Continuation funds are also a viable exit strategy that certainly helps generate liquidity. Asset managers can set them up for a single asset or multiple assets. It is important that the valuation of the assets being transferred is transparent, fair, and that the process is free of potential conflict of interest, which was actually one of the concerns raised by IOSCO in the recent report we mentioned before.
Yeah, maybe looking at another aspect of the market, how about secondaries?
So secondaries exit from LPs rose in 23 from last year as some investors recalibrated their exposure to private assets in their portfolio. It is also a viable exit route for LPs and an opportunity for other market participants, say private fund of funds, for example, to basically secure an attractive discount to NAV. Those can range from 5 to 20% with our observations, with riskier strategies being on the higher end of those observations, basically.
Yeah, on that note, Samir, so the current environment, I'm sure it's bringing a lot of complex cases to address from a valuation standpoint. So what's your experience? So what do you see actually on your day-to-day life?
Yeah, thank you for asking that question. So in certain instances, private companies were already in a difficult situation before the shift in monetary policy in, let's say, current inflationary environment. Some of those companies were not able to withstand the current environment and had to go through a restructuring process with the support of their sponsor GP and sometimes new capital from other GPs focusing on so-called turnaround or distress strategies, both on the side of equity and debt.
Samir, this case is really require detailed scrutiny about the future plans and also the associated risk to that. And also the question is how these plans and risks are captured in the valuation models. And these models are often really complex models. And also, let's say one word about fundraising. Fundraising in the last 12 months are really a topic for the large asset managers. In the past, fundraising was everyone, all asset managers have been able to raise funds, which we have not seen in the last year.
Yeah, so that's definitely a trend that we have seen over the last year, that the larger market participants are attracting also more money. Now I would like us to take the private debt lens. And Samir, you mentioned briefly that the debt financing in the context of distressed strategies. But private credit is not only about the distressed situation, it's also about the companies who seek to finance their activities outside of the traditional banking system. So can you tell us a little bit more about this?
Yeah, sure, Sandra. So private debt financing continues to be a viable alternative to the conventional banking system. It becomes difficult for some companies to raise financing with banks. Generally speaking, private capital as an asset class continues to attract capital, and private credit fund managers continues to deploy capital. We observed a substantial increase in the size of portfolios as there is a limited degree of active management as opposed to private equity strategies.
And Samir, just to jump in here, I mean, the performance of these renowned asset managers has been really good.
Yes, Björn, returns were north of double-digit last year. Private debt managers benefited from variable rates, which were a good hedge against inflation and therefore capture an increase in rates as a gain, while variable margins provide a good hedge against credit risk. Not all is too rosy, though. There have been more difficult cases, and those cases trigger some challenges from a valuation perspective, as valuers need to perform much more extensive analysis on the underlying business to get the valuation right. Valuation of private debt instrument is a complex matter, although it may seem straightforward in the first place. Fair value assessment is even more critical, especially in the context of open-ended funds, which we see more and more in this area.
Yeah, so I would say despite those challenges, I still believe that it remains a very significant asset class. Then, of course, an extensive analysis has to be made, and as you said it rightly, especially in the context of open-ended funds. Now let's turn into the VC, so the venture capital world. There were also some difficulties last year. I would call them even some substantial difficulties last year, especially when we talk about raising of money. Samir, you have some statistics for us, right?
So you're right, Sandra. Venture capital as an asset class experienced a lot of difficulties in capital raise, with only a bit more than 1/3 of the amount raised in 2022.
Fully agree, Samir. We see that investors are definitely more picky and more critical to whom they give their money and when. And also, by the way, Sandra, I have also a statistic. Yeah, I brought it, I looked at it. So bankruptcies for entities and startups, they are really now broken pre-COVID levels. And they are also now at all-time highs, both in the Europe and the US.
Definitely. So we noted that subsequent round of financing were held on pause, pushed away on many of our clients' holdings. Existing investors also participate in round to support their holdings in difficult times as companies experience cash runways in those difficult times. We also observed instances of down round, which means valuation driven down, essentially. An interesting statistic that we found on PitchBook is that the number of unicorns, so for basically venture capital investment valued over $1 billion, so that number actually went down to 100 in 23 from highs of more than 600 in 2021. We also noted the use of instruments in Europe, such as convertible instruments or SAFE as an alternative to standard issuance of shares, which bear their own degree of sophistication and challenges with regards to valuation. And finally, I would say that we observed more and more market participants being mindful of how capital allocation is being made across shares in a complex capital structure of a company in the context of a valuation exercise. Current value allocation was quite common up until now, and now we see more and more market participants consider sophisticated approaches such as option pricing models in the light of the further clarification that was made on that topic by the recent update of IPEV guidelines.
Yeah, so the IPEV guidelines, you mentioned them already 2 times. So I'm guessing it's adding additional possibilities and also for further consideration when you are valuing those particular assets. So this brings me actually to the next asset class where I would like to shed some lights on. So this is the real estate one. Samir, a few words on the real estate one?
So real estate as an asset class continues to be challenged by the current market environment, especially on the side of offices. We observed a substantial decrease in the number of transactions as well as capital raise. Interest rates have been in fact impactful, basically, not only on the asset side, but also on the liability side, as some of those actors have financed properties with floating rate interest. Valuation have adjusted downward, but managers continue to believe that assets are overvalued, according to the last report that we've seen on Preqin.
On that one, Sami, I think I have a bit of a different view, given also my experience now at the MIPIM. So my takeaway from the MIPIM was on 3 different points. So the first one was that I think there is a belief that the prime capital values are bottom out in 2024 for the European real estate market, and that overall there is not an expectation of a strong rebound as long as the cost of debt are on this high level. So that was my first takeaway. The second one was really on the dry powder. Dry powder is still there and the amount is really high. And I mean, a lot of managers are looking into that and they would like to deploy the capital into value add and opportunistic strategies. And the third point was really that the deal activities is expected to pick up in 2024 as the capital values are solidify and the capital market conditions are much better. And that also means, when the values are stabilizing, it's also good for the buyer and the seller because it gives you more comfort on the current price levels at the end of the day. And also my last point, which I think is also interesting, is that I guess there will be also transaction opportunities because some of the loans will have a maturity now, and that's trigger also these opportunities.
Okay, so that's a little more positive from what I hear from Björn. So let's continue a little bit more on this positive line, looking at the infrastructure. Yeah, is there a silver lining? Samir, what do you think?
Yeah, so we've seen quite resilient and strong momentum for renewable energy asset, as well as data centers, underlying recent geopolitical context in Europe, as well as strong development on new cloud-based and AI-driven technologies, which obviously require lots of computational power. Electricity prices have increased, which is positive for projects that are merchant. But this has been offset by higher interest rate environment when projects, especially when those need to basically refinance. Valuation remained elevated as it is still an attractive asset class, which is expected to be present in portfolios. Valuation probably did not adjust fully to reflect current market conditions, despite remaining attractive. An interesting statistic from AIC shows that the level of the discount of price to NAV of listed funds investing in infrastructure assets in the UK currently is sitting at 20%. This seems to indicate that public markets may not be in full agreement with valuation retained in NAVs. Model complexity remains a challenge for everybody within this asset class, especially as valuation functions of AIFMs in Luxembourg generally ask us how far should we go in order for us to perform our oversight.
Yeah, so the challenges on valuation and especially the regulatory guidelines that are there will help us, so there's more guidance. And of course, I can imagine already the questions in relation to how far do we need to go in terms of oversight. This is actually the point in time where we have put the lens on different asset classes. So we started with PE, we went to private debt, we spoke about venture capital, but also the real estate and the infra. Björn, this is the point where I would like you to wrap up and tell me what are your 3 key takeaways.
Sure, Sandra. Happy to summarize. It was really a lovely conversation with both of you. I took note of the 3 following key takeaways. Number 1, the asset classes in private markets have been differently impacted in the last year, and I feel a positive sentiment for 2024. Second point, valuation is really a key focus area for the regulators in Europe and beyond. And third point, technology, including the use of AI, is key to support the market and will help us to increase efficiency.
Thank you, Björn, for sharing that with us. Samir, we have a habit here in this podcast and actually asking you for a number that strikes you. So, Samir, what's your number?
So my number is 29%. So to your point, Björn, this is the percentage of valuations performed with a non-Excel based model. This is a substantial increase from 2019, where the number was actually 10%.
Still extremely impressive, huh? That still 70% is actually made on Excel.
Yeah, that's right. So we see many actors in private equity, private debt, as well as venture capital use those valuation platforms. We happen to have our own platform at PwC that we use and that our clients uses, and we expect this trend to continue in the future.
And by the way, Samir, Gen AI is really close to my heart. And as you know, we announced last week that we open up here in Luxembourg the Gen AI Business Center and also the partnership with Microsoft. So that is really a topic on spot on.
Yeah, so it remains just to me to say thank you to the two of you. So thank you, Björn, and thank you, Samir. And I wish you an excellent day.
Yeah. Thank you, Sandra. Thank you, Samir.
Thank you very much, everybody.